Welcome, future investors. Today, we step into the fascinating world of precious metals investment, a realm where gold, silver, platinum and palladium reign supreme, and where the potential for profit can shine as brightly as the metals themselves. But as with all investments, these opportunities don't come without their fair share of risks. Precious metals investment is not just about hoarding gold bars or silver coins. It's about understanding the market dynamics, the factors that influence prices, and the different ways to invest. It's about diversification and how metals can add a layer of protection to your portfolio, serving as a hedge against economic uncertainties and inflation. Yet it's crucial to remember that the world of precious metals, while full of potential, can also be unpredictable. Market volatility, liquidity issues, and counterparty risks are just a few challenges that investors might face. Investing in precious metals can be a golden opportunity, but like all investments, it comes with risks. Diversification is not just a buzzword in the investment world. It's a powerful strategy that can help you navigate the stormy seas of the financial markets. But what exactly is the diversification and why is it so important? Well, imagine you're putting all your eggs in one basket. Quite risky, isn't it? If you drop that basket, all your eggs could break. That's what happens when you invest all of your money in one asset or one type of asset. If that asset or sector takes the hit, your entire investment portfolio suffers. But if you spread your eggs across different baskets, or in investment terms, if you spread your investments across different sectors, you reduce the risk of doing everything when one asset or sector underperforms. That's the power of diversification. It's about creating a balanced portfolio that can withstand fluctuations in the trade market. It's about not putting all your faith in one asset or sector, but spreading your investments across various assets to mitigate the risk. Now, where do precious metals fit into this picture? Precious metals like gold, silver, platinum, and palladium offer a unique opportunity for diversification. They are tangible assets that hold intrinsic value. Unlike stocks and bonds, the value of precious metals doesn't depend on the company's performance or economic conditions. In fact, precious metals often move in the opposite direction of traditional assets. When stocks and bonds are down, precious metals tend to perform well. This inverse relationship makes precious metals a valuable tool for diversification. Adding them to your investment portfolio can help smooth out market volatility and reduce overall risk. But remember, while diversification reduces risk, it doesn't eliminate it. Investing always involves some level of risk, so it's important to carefully consider your investment decisions and seek professional advice. Remember, diversification is key to break through long-term financial markets. So you're ready to dive into precious metals, but where do you start? Let's first talk about physical bullion. This is the most direct way to own precious metals. You can buy gold bars, silver coins, or even platinum ingots. The advantage is that you hold a tangible asset, something you can touch and feel. However, the downside is that you need a secure place to store them, and selling can sometimes be a challenge. Next up, exchange-traded funds, or ETFs. These are investment funds traded on stock exchanges. An ETF can track the price of a single precious metal or a group of them. It's a convenient way to get exposure to precious metals without the need to store or insure them. But remember, with an ETF, you don't actually own the metal. You own shares in a fund that owns the metal. Then we have mining stocks. Investing in a company that mines precious metals can be a profitable venture. If the company discovers a new deposit or increases productivity, the stock price could rise. But it's also risky. A natural disaster or a drop in metal prices can hit the company's profits and your investments. Lastly, there are futures contracts. These are agreements to buy or sell a specific amount of a precious metal at a future date and a set price. It's a way to speculate on price movements without owning the metal. It can be lucrative, but it's also complex and risky, especially for beginners. Each of these methods provides a unique way to invest in precious metals. Physical bullion gives you a tangible asset. ETFs offer convenience and ease. Mining stocks present potential for high returns, and futures can be a tool for speculation. But each also comes with its own set of challenges. The key is to understand what you're getting into. Do your research, weigh the pros and cons, and most importantly, consider your own risk tolerance and financial goals. Each investment method has its advantages and challenges. Choose what fits your risk tolerance and financial goals. Prices of precious metals aren't set in stone. They dance to the tune of various factors. Just like any market, the precious metals market is influenced by a myriad of elements, some of which we'll delve into. First and foremost, supply and demand play a significant role. For example, if new gold mines are discovered, the increased supply could potentially drive prices down. Conversely, if a major industrial use for silver is found, demand could skyrocket, pushing prices up. Then we have economic indicators. These are statistics that signal the current state of economic affairs, and they have a direct influence on precious metals prices. Think along the lines of inflation rates, gross domestic product, or job growth rates. When the economy is strong, investors often gravitate towards riskier, high-yield investments, leaving precious metals behind. But when the economy is shaky, precious metals often shine as a safe haven. Geopolitical events and uncertainties are another important factor. Precious metals, particularly gold, are often viewed as a crisis commodity. So when tensions rise, whether due to conflicts, elections or trade wars, investors may flock to precious metals, driving up prices. Currency values, especially that of the US dollar, also sway precious metals prices. This is because these metals are priced in dollars. So, when the dollar is strong, it takes fewer dollars to buy metals, causing prices to drop and vice versa. Lastly, central bank activities can impact prices. When central banks, which hold large amounts of gold in their reserves, decide to buy or sell, their actions can cause ripples in the market. These factors are intertwined and can influence each other, creating a complex and ever-changing landscape. But don't be daunted. Keeping an eye on these elements, understanding their potential impacts, and staying updated with global news will equip you for your precious metals investment journey. Understanding these factors can help you make informed decisions in your precious metals investment journey. Investing in precious metals can be rewarding, but it's not without its risks. Just like any other form of investment, precious metals have their own set of potential pitfalls that you need to be aware of. One of the key risks lies in market volatility. Precious metals, much like other commodities, can see their prices fluctuate significantly over short periods of time. This volatility can be influenced by a variety of factors ranging from global economic conditions, geopolitical events, to even the whims of market speculators. For beginner investors, this unpredictability may be a little daunting. Another risk to consider is liquidity issues. While gold and silver are fairly liquid investments, the same cannot always be said for other precious metals like platinum and palladium. If you need to convert these investments into cash quickly, you might find it more difficult than you anticipated. Let's not forget about counterparty risks. If you're investing in precious metals through ETFs or futures contracts, you're relying on another party to fulfill their end of the deal. Should they default, your investment could be at risk. However, don't let these risks deter you. There are ways to manage them. Diversification, as we've discussed earlier, is one of them. You don't want to put all your eggs in the precious metals basket. Spread your investments across different asset classes to mitigate risk. Another strategy is to have a clear understanding of what you're investing in. If you're considering ETFs or mining stocks, make sure you do your homework. Understand the company's financial health, their mining operations, and the market demand for the metal they're producing. Lastly, consider your investment horizon. Precious metals can be a good store of value over the long term. They can act as a hedge against inflation and economic uncertainties. But if you're looking for quick returns, they might not be the best choice. Being aware of these risks and how to manage them is crucial in your investment journey. It's not about avoiding risks completely, but understanding them and making informed decisions.